For the next 40 minutes or so, we are going to talk about innovation inside large banks. In recent years, there's been a remarkable breadth and depth in the capacity for innovation in financial services. There have been enhancements to payments infrastructure, distributed ledger technology, and also regulatory evolution. And these enhancements have affected how financial institutions invest and compete regardless of size. And so we are very fortunate to be joined by three panelists who are deeply involved in working to ensure that the nation's largest banks innovate alongside the rest of the economy and continue to serve customers as the speed of commerce and markets accelerate. I think we heard some of those themes from the secretary during the prior discussion. So just for brief introductions, we have Aaron Iovine, who's the Global Head of Digital Assets and Regulatory Policy at JPMorgan Chase. Justin McCormack, who's the Head of Digital and GlobalLink Legal at State Street. And Lee Brenner, who's the Head of Public Policy and for Digital Assets at Goldman Sachs. And I can personally attest that these are all experts very much so in this area. So I think we'll have a great discussion, and I think they each bring perspectives about what it means to innovate at large organizations, how policymakers are considering the evolving landscape, and how innovation looks different in 2023 and beyond. So I hope you all will share your experiences and perspectives that you've gained at your organizations and what we should expect. Look, I'll just make a couple more comments and then dive right into it. But I think the changes that are happening in terms of the innovation in the financial services sphere are really important because they have the potential to improve the client experience and to make financial services more efficient. And that is all for the good. But I think it's important to keep in mind, in particular here in a setting where we have representatives of the government and policymakers in the room, that innovations are not riskless. Financial services firms and governments and regulators and policymakers have to understand, anticipate, and prepare for these and other developments, both to remain competitive, I think again, as we heard on the prior discussion, and to help ensure that risks are being appropriately managed. So with that, maybe Aaron, we can start with you. JPM has a relatively well-publicized business referred to as Onyx, which the JPM website says is transforming the way money, information, and assets move around the world. Sounds ambitious. Can you tell us about what Onyx is, how it uses blockchain, and how it fits within JPM?
Yeah, of course. Thank you. So Onyx is a unit inside JPMorgan. They have developed private permission blockchain solutions, and as David had said, really focused on financial markets infrastructure of the future. And so when we think about the movement of money, assets, and information globally, that is all happening inside Onyx. The team is really working to re-architect modern payments infrastructure to solve for some of the inefficiencies or barriers or just some of the pain points that we see today with existing systems. And so when you think about the different units inside Onyx, it's actually quite expansive and complex, really a talented team. There's the coin systems team that's focused on the money aspect. There is the Onyx digital assets platform itself that's focused on the movement of assets. And then there's Link, which is another platform really focused on the movement of information and how do we utilize how do we utilize the blockchain for each and every one of those solutions?
That's great. Is there anything you can say to elaborate on sort of specific use cases? I know you kind of went through the different units, but can we sort of bring that down to a little bit more of a granular level?
Yeah, absolutely. So Coin Systems is a blockchain-based deposit account system for existing JPM clients. And so it's focused on the clearing of instant payments globally. And so it's multi-bank, multi-currency, and really giving control of programmability of money, the future movement of money to the clients itself. And then when you look at ODA, Onyx Digital Assets as a platform itself, there's a number of security services and security settling solutions that we offer to clients. I think one really great one is digital financing, right? So how do we utilize blockchain for intraday repo agreements and transactions, and how does the blockchain provide greater transparency to the life cycle of the loan, greater control to the clients in terms of timing, so how long is the collateral actually locked up, the programmability and movement for atomic settlement, really empowering the clients to take control, their treasury management. For corporations, obviously, that is huge. How do you better utilize assets? How do you move them more efficiently? And how do you manage your balance sheet there? So that's a great use case, I think, of really solve some of the pain points we see today. Then there's also Link, which is, again, information sharing. So financial institutions collect, obviously, a large amount of information on transactions, and part of their core competency is ensuring compliance, ensuring they're cutting down on fraud and other illicit activities. So how do institutions use the blockchain to share information that they have readily available and really help to cut down on fraud in some of those other activities? So really, again, it's the transformation of and the re-architecture of the movement of money, assets, and information throughout financial services.
Really interesting. Anything you can share about what we should expect over the next couple of years?
Yeah, it's really interesting, I think, to look forward at what the products are. And so one of the things I think we can expect to see is continued growth. I think the Onyx platform has had a great deal of demand, a lot of interest as different institutions through the industry explore their own blockchain evolution and development. And so we're going to continue to see that growth, continue to see clients who want to play in the space either just to get exposure to the technology, who want to do more transactions, who really want to move some of their core infrastructure. So I think you can anticipate certainly seeing a lot more of that. I think you can also anticipate to see the thing I'm most excited about, a transformation of the technology from a mindset perspective. So a shift that this is something quite novel to a core offering, the same way banks offer ACH and wire payment solutions. You're going to be able to see that with blockchain-based solutions, and whether it's, again, the expansion of coin systems or ODA and what they're doing on the digital asset platform there. I think you're going to see continued growth. I think obviously there's a big focus and a lot of interest around tokenization, and then when we see the possibility of the evolution of money for deposit tokens, what does that look like? And certainly, if you have not read the JPM Oliver Wyman paper on deposit tokens and the future of money, I highly recommend that read. A shameless plug for the Onyx team here. They really did a fantastic job, I think, of breaking down and making digestible some of the terms, the actual transaction and use cases, and then how they see that future gradually evolving. I think when we think about technology and we look at this wide scope of what is blockchain and the solutions, that's going to be a process, right? It's not going to be overnight. It's going to be growth. It's going to be sustainable, and it's going to be continued. So I think that's a great portion, and obviously that will, part of what happens with future offerings beyond expansion of existing and how we build the future is how the regulatory environment globally continues to evolve. So we're looking at really global scalability of blockchain-based solutions, and how do we fit that in the existing regulatory structure? How do we collaborate with regulators, with industry to create clarity around the regulatory structure where there might be some existing gaps because of the novelty of the technology? And I think that's really exciting as we look towards the future, but always there to really collaborate and work together to define the parameters and bring this technology into the regulatory perimeter.
Yeah, 100%. And I like how you gave everyone a homework assignment. So we'll have to talk to the forum team about a way to quiz everyone at some point and find out. But I think that's a great segue, Justin, to move to you and maybe to level set a little bit for the audience about what a global custody bank like State Street does. Can you give us a very basic sense of the role State Street plays in the markets and maybe how that's relevant to this discussion about innovation?
Sure. That's great. So State Street, as a global custody bank, it provides numerous financial services, and we can kind of categorize it into two main groups. One is asset management, which you may know is State Street Global Advisors and the SPDR funds. The other area is investment services, and that's really what I'm going to focus on today. In the investment services business, the core of that is custody or safekeeping. So it's holding the assets of our clients in a safe and secure manner, and then facilitating the settlement of transactions by our customers. In addition to that, there are a number of ancillary services that come off the custody solution. For example, there is foreign exchange transactions. So we engage with our clients in foreign exchange transactions to allow them to settle their securities transactions in other currencies. Securities lending is another aspect. So clients have securities in custody with us. We can act as an agent to facilitate their lending of those securities in the market to facilitate liquidity. There are sponsored repo transactions. So we would engage in sponsored repo with our clients to facilitate overnight money cash investments. In addition, we act as a fund administrator. One of those roles could be as a transfer agent. So as a transfer agent, we facilitate the issuance of shares of mutual funds. And we are able to do a number of these activities because of our involvement in financial market infrastructure. We have accounts at clearinghouses, accounts at central securities depositories, accounts at the Fed, and our kind of interconnection with the global financial market allows us to facilitate transactions while maintaining the safety and security of our clients' assets.
Yeah, I mean, it's remarkable. Every time I hear it, it's remarkable just how a bank like State Street really sits at the core of the financial markets infrastructure in terms of where assets are held and how they move around. In light of that, how do you all think about innovation or the bank innovating to continue to play that role as financial markets evolve and everything Aaron said will happen happens?
Right. It's a great question. And I think there's, obviously, innovation is key. I think when the digital world has been kind of growing over the past couple of years, there's been a sense that, okay, well, intermediaries are no longer going to be needed. The intermediaries would go away. We don't think that's the case. I think what we've seen in the market in the past couple of years with things like FTX and other scenarios, it was the intermediaries that didn't work. They naturally formed, but they weren't regulated. And so what we bring to the table is a well-established intermediary that has safety and soundness at its core, and we look to innovate the way in which we're going to provide our services. Our services are still going to be needed. It's just going to be a different way in which those services are needed. And so that's where we're focused on making sure that we can keep pace with innovations in the market and also make sure that the way in which we are supporting that innovation is done with a focus on managing financial stability, managing customer protection, and ensuring that we're bringing safety and soundness to this new world and facilitating the same types of interactions that we do today.
Yeah, that's great. And maybe if we could unpack that a little bit, are you able to give us some kind of specific examples of initiatives or innovations that are underway, sort of a glimpse into the future of what State Street can do?
Yeah, and so as I said, we are a large custody organization, custody bank. So one of the initiatives that we're working on is custody of digital assets. And as I mentioned earlier, a big focus of custody is control. How do you control the assets and make sure that they are held in a safe and sound manner? So we have great history and great expertise at doing that, but with digital technology, blockchain, distributed ledger technology, we have to figure out the best way to make sure we can maintain control in a way that meets regulatory expectations and our clients' expectations. So we've spent a lot of time building up basically a wallet infrastructure. So digital assets, they're held in wallets on a blockchain, and the way you control those assets is through maintaining private keys. And so we've been spending a lot of time developing a strong key management solution to ensure that we have control over those assets at all times while they're in our custody. So that's one of the core activities. We're starting with Bitcoin and Ether is where we're planning to start our solution, but we do expect that it will grow to digital assets that are tokenized assets, so tokenized traditional assets, and we think that's really where the growth is going to come. And having the ability and having the experience of custodying digital assets will allow us to grow with the market and support our customers who are going in that direction already.
Yeah, and maybe we can come back to tokenization in a little bit, but before we move on, as relevant to everything you just said about the ability to maintain a customer's private key, can we touch on something maybe the audience has heard about? Certainly, I think a year and a half ago was receiving a lot of attention, which is Staff Accounting Bulletin number 121 issued by the SEC. Actually, I remember at the last year's Financial Services Forum Summit, that was a topic in the panel I was on with Commissioner Pierce from the SEC. But what's the relevance of that staff guidance on the ability of firms to innovate, to perform these roles, to manage private keys for clients?
Yeah, so Staff Accounting Bulletin 121 was issued by the Office of the Chief Accountant at the SEC, and it essentially kind of had at its core two main requirements. One is that entities that are safekeeping or custodying digital assets needed to include a number of disclosures to their clients, risk disclosures in their financial statements about the risks associated with that, which makes a lot of sense. And then the second aspect was to ensure that those entities include on their balance sheet both an asset and a liability equal to the fair market value of those assets. And for most public companies that this applies to, who are not banks, it's more of a reporting exercise. It doesn't have a fundamental impact to the way they run their business. For a custody bank or a bank in general, when you put an asset on your balance sheet, that means you need to hold capital against that asset. So it makes the activity of custodying assets much more expensive for the bank. And so as we go through this process and we have SAB 121, it essentially provides a hindrance for banks to be getting into this business because it makes it a lot more expensive. Traditionally, in custody of traditional assets, those do not go on the balance sheet. So this is it makes the activity more expensive than it would otherwise be. And I think there's a challenge here too, because as I mentioned, a core aspect of what a custody bank does and what a bank does generally is to ensure that we are doing things in a safe and a sound manner, and that we're managing our clients' assets in a way that facilitates financial stability. By having SAB 121, it makes it harder for banks, who are the entities that are kind of most suited to bringing stability to the digital asset industry. It kind of keeps them out. One of the things that we've seen with custody and with the issues that we've seen in the digital asset industry in the history in the previous few years has been that there's the core aspects of custody haven't been respected. So there hasn't been separation of activities, so that you had exchanges and custodians and brokers all being the same entity and kind of commingling the assets in a way that doesn't support bankruptcy remoteness. That's not something that a bank would do. We don't have segregation of client assets in what we've seen in the marketplace to date. As a custody bank, that's at the core, is making sure that our clients' assets are kept separately from the bank's assets, and so that in the event of an insolvency, the client's assets are protected. The clients have the rights to those assets. And then risk and controls, obviously, that's a big aspect of what the banks do. And I guess one other kind of separate from SAB 121, but in terms of how custody banks and others can be innovating. So custody is a core aspect of what we're doing, but there's also a way to use the blockchain digital ledger technology to enhance existing operational processes and reduce operational risk. So for example, one project that we've been involved in is using blockchain technology and smart contracts to facilitate calculation of margin on derivatives trades. So you can use a smart contract to calculate the margin in reducing the need to have separate operational teams manage that process. And then through a link to the custody account, enable a smart contract to put on a pledge of those securities. So you can kind of have real-time or near real-time ability to manage risk in the marketplace. So just want to make sure that mention that as well, because it's not all about digital assets. It's
Right.
digital assets and the technology.
Yeah, it's all really interesting. Lee, maybe we can move on to ask you a little bit about how GS is looking at innovation in the digital asset space, and maybe you can provide us some highlights.
Yeah, absolutely. So yeah, Goldman Sachs is obviously focused on innovation from both building up a very strong engineering team, both for digital assets and across other aspects of technology and how it can be used to really make the operations of the entire firm more efficient. Specific to digital assets, I mean, there are really three buckets. There's investing in growth companies that are trying to build the blockchain infrastructure, right? So there are many really focused on infrastructure companies like TRM Labs and Anchorage Digital, and people that are helping to build the ecosystem and make sure that it's safe and secure as it grows. Then it's client facilitation, right? We're clearing Bitcoin and Ethereum futures. It's thinking through how making the client services that we offer across the board more efficient, more cost effective, more risk managed, and using that technology really to think through all the operational efficiencies that can be built through blockchain and DLT, and really trying to develop how platforms to digitize the entire life cycle of assets. So an example, we developed what we're calling DApp, the Digital Asset Platform, which is really a way to tokenize assets, the entire life cycle of a process, which can then, again, make things more efficient, speed up the process, lower the costs for our clients, and then really trying, as a highlight, I think, which we've all discussed, is trying to manage risk in a much more efficient way than done even previously. And one great example is that the European Investment Bank tokenized a bond, which they did through the Digital Asset Platform at the end of last year, and really, it was $100 million. It was a 2-year bond. But just showcasing the speed at which they were able to facilitate that in a matter of minutes and hours versus what it normally takes to do that in a traditional process, and lowering the cost and everything else. And so I think we're going to see more and more of those types of things over time as both on our platform, as you're able to tokenize more of these assets and showcase how it actually lowers costs and makes things much more efficient, and for regulators also showing that the risk is actually lowered by doing it this way.
Yeah, that's great. And maybe we can zoom out for a moment. We've talked a little bit about what each of your respective firms are doing. And I have to say, just listening to it, it's clear that there's just so much going. Well, the firms are very future looking, or are very much concerned about where the future goes and putting a lot of resources into making sure that they can be there. But maybe we can touch for a minute on how policymakers are looking at innovation, both in terms of regulatory policy and innovating their own operations. And Lee, if it's okay with you, maybe we can stick with you, and if you want to touch on central bank digital currencies.
Yeah, absolutely. So I think as the digital asset and cryptocurrency markets grew, I think in response, a lot of governments and central banks around the world started to explore CBDCs in a way. One is I think both a way for the governments to try to say, all right, we're going to keep up with this innovation, and then also to make sure that they were in sort of a response to some of the announcements about stablecoins and others that have come either from Facebook or so even the growth of the technology in the private sector. So I think you're seeing policymakers, well, especially the regulators and central banks, do a lot of research. I mean, there's almost most of the governments around the world are really starting to research it at least. And then there's a competition aspect to it, right? So jurisdictions are trying to figure out who's going to be first, how are they going to compete with China, which already has its digital yuan out, and China's very much focused on that. Europe, just yesterday, Christine Lagarde said that the digital euro is still 2 years away, but she's trying to convince folks that they're going to spend that time to actually try to push it forward. From a perspective of banks, I mean, we've really tried to focus on the fact that if a CBDC is to come forward, we really think that a wholesale CBDC is the way it should be done, and that a retail CBDC, it could potentially be problematic for a lot of banks. And I think we've tried to work with governments and multilateral organizations like BIS, who are doing a lot of this research, to make sure that they're understanding that any sort of innovation that they may push forward from a central bank perspective needs to take into account how it will impact the current market and current financial institutions and what that means for, in the end, consumers.
Right, yeah, of course, that will be critical. And you started to touch on activities around the globe. Maybe Justin, if you don't mind commenting, what's the difference between the approaches here in the United States and in other jurisdictions regarding digital assets more generally, not just on CBDCs, but do we see different approaches around the globe?
Yeah, we really do see kind of different approaches and by region in a number of cases. So in the US, the approach has been more of caution and a little bit restrictive. And so there's still a lack of clarity as to exactly where a digital asset falls, which regulator has the oversight of the particular digital asset, whether the digital asset, what's the category of the digital asset? Is it a commodity? Is it a security? Is it something else? Outside of the US, we're seeing, in many places, we're seeing a lot more kind of advanced approaches to things and really kind of tackling things head on. So for example, in Europe, earlier this year, the markets and crypto asset regulation was adopted in the EU. That creates a framework for crypto assets that are not financial instruments. And it puts in place a structure to regulate the crypto asset service provider. So basically the intermediaries for those assets. And so it's bringing some clarity to what the assets are, how they're going to be treated from a regulatory perspective, also what the expectations are of the parties that are providing services with respect to those assets, which is, in my view, goes a long way to helping ensure financial stability, because the intermediaries in the past couple of years is where we've seen the real risk to the market be manifested. You also see the UK, while they're kind of going at their own pace, they're not subject to MiCA as a result of Brexit. The Law Commission in the UK has come out and created papers saying, well, we don't think we really need to change our law that much. We do have, our laws largely work to support crypto assets or digital assets. Maybe some minor or some changes that could be done, but proposing areas where that can be done. And the UK is also being, they're trying to attract a lot of investment and to support this innovation through the creation of sandboxes and things of that nature. And then as you go out to the Asia Pacific region, a number of jurisdictions there have kind of created environments that foster development in a measured way. So for example, in Singapore, they've created legislation to regulate digital payment tokens, which are essentially crypto assets. They've created a number of sandboxes to facilitate the innovation in trying to figure out in a controlled manner how these assets and this technology can be used and can benefit the markets. In Japan, again, it's another market where they actually have a stablecoin law that has now become effective and in compliance earlier over the summer. And so really kind of creating legislation that supports the market. So we're seeing a number of different approaches. Really a number of markets that are kind of addressing this to say, these assets are here, this technology is here, so let's try to control it and manage it in a way that people understand how it works and what's expected of them when they're dealing with it.
Yeah, and on that score, one of the ways the policy process works around the world is when regulators and global standard setting bodies issue consultations, really requests for comment. They put ideas out there and solicit feedback from all stakeholders. Maybe, Aaron, you can sort of enlighten us a little bit in what themes. I know there's a lot of consultations in this area out or recently closed. What are the themes we're seeing in those consultations, and what observations do you have on those themes?
Yeah, it's definitely been a busy 12 months, but I think that's a good thing, right? We have a great understanding of the regulators' thought process, their key concerns, the areas of focus. And to your point, David, it really gives industry a great opportunity to engage, to provide response, to give more detail and paint more color on the solutions, on the technical focus, the risk management perspectives. It really gives a really powerful engagement platform, I think, for the industry as a whole. And so there are some really positive things, I think, when you look especially at the global level and standard setters and what they're trying to do. And I think one of the things I'm most encouraged by is the continued call for communication, collaboration, and information sharing across jurisdictions, really, to try to create a uniformity in how this asset class and technology are looked at, how they're regulated, how those risks are managed. And I think that's extremely important when you think about, especially institutions like ours, that take a very global perspective, global scalability, and you want to ensure that there's some sort of uniformity, that you're not having to go across every single jurisdiction with vastly different requirements and standards. It creates a lot of difficulties in setting up internal processes, obviously. The ability to collaborate and have that uniformity is also important, I think, in terms of regulatory arbitrage and creating a strong regulatory response for institutions to plan around it. And then it creates a level playing field as well. So it's really important that collaboration continues to happen on a global level. And it's really important that industry continues to engage to really paint a picture of how they're managing risk on a global scale. I think that's something, again, that's probably quite unique about this technology and the asset classes as a whole. Something else I'm encouraged by is seeing the regulatory agencies try to move to a more tangible definition around the principle of same activity, same risk, same regulatory outcome, and what does that really mean? And I think that's helping to create clearer rules to the road and guidance. What are the guardrails that the regulators are expecting for certain activities when you're incorporating the technology? And that sort of clarity and way forward, I think, really paves institutions' paths for innovation, whether it's developing, deploying, or investing in, internally or in partnerships, incorporating the technology as a whole. Without that level of clarity, it becomes very difficult. I think we're, again, a very compliance-first firm, so we're not institutions that are going to be front-running regulations, right? We want to see that our products and our ideas neatly and clearly fit unambiguously under that framework. And again, how do we collaborate with regulators through this process to make that happen? I think, something I think that we all collectively can contribute to moving the needle here from a policy perspective is helping with taxonomy and uniform definitions. It's a pretty rapidly evolving ecosystem with numerous different solutions, a lot of different players. And I think unintentionally what we see happening in some of the efforts are the technology itself, the asset classes, the types of institutions offering them, and their risk profiles sometimes get conflated. And that creates a lot of difficulty in creating an appropriate regulatory environment that's matching the actual risk of the activity itself. So again, I think it's something that's a little more unique about blockchain technology as a whole, but there are nuances in the tech that need to be accounted for. And there are nuances, again, between what a deposit token would function and, say, a stable coin, which are two totally separate assets, two different types of institutions that are issuing them, and obviously the risk management portfolio, the capital requirements, the oversight of those types of institutions. And so when we start taking the lens of that nuance, I think we create a holistic regulatory framework that manages the gaps, right? I think a one-size-fits-all blanket approach will unintentionally create gaps. And so we really have to focus on what we're discussing, what the unique risks are, and how we manage those for the integrity of the financial system, consumer protection, I think safety and soundness as a whole. And we continue to do that through tightening up some of the definitions there.
Anna, can I just jump in?
Yeah, please.
The more that the engagement that Aaron's mentioning between regulators, policymakers, and financial institutions, both traditional and otherwise, I think it opens up the dialogue so that you're starting to see more and more regulators understand that the genie can't be put back in the bottle. Even though some of the more critical regulators and policymakers of the ecosystem have acknowledged that it's here to stay. They've started to talk about tokenization and the idea that blockchain and DLT is going to be used in the long term. And then getting to that nuance that Aaron was mentioning allows them to start thinking through what it means in a broad ecosystem for different players, right? What it means for institutions like ours that have robust risk management platforms, robust controls already built in for our traditional processes that all of our new activities are going through as well. And the regulators are constantly talking about how they want to have oversight on the new ecosystem and the platforms that don't necessarily have these controls. And we can be an example for the broader ecosystem because all the new technology that we're using is going through these systems already, right? And so really we can be a model for the growth of the ecosystem.
The growth and how to bring it into the regulatory perimeter, right? In a safe and responsible manner. Right? And again, I think sometimes it's just getting back to basics. It's distinguishing the technology and the underlying tech from the assets themselves. And I see often that gets conflated in conversation. And when we start there, it's a lot easier to manage the risks as you start building out across the ecosystem.
At the beginning, Aaron, you mentioned Onyx being a private permissioned environment. This commentary reminded me about risk management and how banks distinguish themselves in that way. Made me wonder if we should come back to that and just explain for the audience like what that is and how it contrasts to a public permissionless environment, or what the opposite is.
The opposite end of the spectrum. No, I think that's helpful. And again, this is where you see sometimes unintentional conflation, right? So you have the underlying network can either be private or public. And then on top of that, you have an ability to create certain permissions. And in the middle, there's still a hybrid that I think probably deserves more attention than it gets. I think often we talk about either you have to do it on a private permission system or public permissionless, but there is a public permission system. And so if we start at private permission, basically it is a closed loop network where an institution has built the blockchain, they know all of the node validators, they have the essential controls over who is allowed to participate in the network, what information they have on that network, what types of transactions they can undergo. And so when you think about things like KYC, AML requirements, it's really beneficial when you know all of the parties, you have the necessary information. It pretty neatly fits in with some of the regulatory requirements we see today. And then, I think there's the question of, it always gets to scalability, right? So when we talk about global scale, and other institutions have built private permission systems as well, how do you make those interoperable? Because that is going to be the key to making the technology function and realize some of its promises that fix, again, some of the existing clunkiness that I talked about that Onyx is trying to solve for through a number of their applications. So how do you make those private permission systems interoperable? How do you build bridges? How do you control the cybersecurity threats that happen within those bridges themselves? Right, those are all unique factors to private permission system. And on the totally opposite end of the spectrum, you have public networks where anyone can participate. Really, that pseudo-anonymity that people want to focus on is optional. It's prominent there. And that, I think, has a whole different set of concerns. Obviously, the regulators have stated how financial institutions can compliantly engage with that. And how do you account for those? There are different, I think, cybersecurity risks in engaging at that, different KYC, but you certainly, you get to some of the advanced solutions where you're starting to talk about verifiable credentials where you have the ability, again, and now we're getting into the hybrid where you actually are able to build certain permissions on top of these public networks, so you have the control, you can see who's engaging, you can ensure that you're complying with AML requirements, that the assets are not flowing to illicit wallets and you're not unintentionally interacting with bad actors. And I think verifiable credentials will play a pivotal role there, and again, a totally unique set of regulatory requirements that need to be examined when you look at each and every one of those systems.
Yeah, it's really helpful. Maybe lastly, before we close, Lee, a trending topic, and the Secretary mentioned it in the prior conversation, seems to be AI, both in terms of the promise it may offer and the risks it presents. I think we heard the Secretary mention both of those. How do you think about AI and the future for large banking organizations?
Yeah, it's definitely a buzzword, but I think it's the speed at which the conversation around AI has grown in the past year compared to many other technologies over the last 10, 15, 20 years is pretty profound. I think already industries like ours and around the world are using pieces of AI, right? It's already in existence. But I think what we're talking about now is generative AI, machine learning. We're, as an institution, really paying a lot of attention to it, trying to do it in a careful manner, but making sure that we do it to make sure that it's done in a safe and sound practice. We're exploring the ways it can be used to very similar to digital assets, to make our operations more efficient, to make our people more efficient and enhance the way that they're doing processes. Just as an example, we're doing some testing on the ways that our developers and our engineers can develop code, right? So that's built into much of our processes already in terms of using code and how our analysts are doing things. And so if you think about how AI could potentially say, an engineer could think through, all right, here's what I want this code to look like, or want it to do. You can start the process, and an AI system could potentially build out that code in a matter of seconds relative to someone doing it on their own and taking a lot of time. And then obviously people will have to review it and go through it, but it just enhances those engineers and their ability to build processes and help again, client facilitation and thinking through what we're doing for our clients and our customers in the end. So trying to be very careful and thoughtful about it. I think regulators and policymakers are doing a pretty good job so far, because over the past years there's been so much attention, and even the past couple months on the Hill and around the world on AI. And I think the Senate Banking just did a hearing on it. So I think more and more you're going to start hearing about these conversations with the private sector, with public policy practitioners, and keeping that dialogue open is going to be real important for the way we move forward in this space.
Yeah, that's great. I think that more or less wraps us up. I don't know if anyone wanted to say something that they missed the opportunity to say earlier, feel free.
Yeah, I mean, just quickly, I think going off Lee's last comment, I think there's an underlying theme to how financial institutions look at innovation as a whole that we'd be remiss to not talk about. And it is that risk management profile, and it's that consistent evaluation, right? That you don't need new regulations to tell you need to consistently evaluate the evolving cyber threats of new technology, and whether it's AI, blockchain, or the existing digital systems today. Financial institutions, I think, are the best equipped to manage those risks, have the most complex processes in place, and will continue to invest in defenses against those potential threats. It often gets lost in some of these conversations that financial institutions are actually natural consumers of technology and innovation. It's part of their core competency is to build that next wave and next generation, and whether they do it internally, whether they partner with other institutions or acquire, the process ultimately internally is the same, and that risk management framework is no stronger than anywhere that besides financial institutions, really part of their core competency, no matter what technology you're talking about.
Yeah, I would agree with that, and I think it's also it's designed, the way in which that risk management profile or framework is specifically designed to address innovations in technology like this. So there are, within a financial institution, there's an organization that's devoted solely to cybersecurity. And we're working closely with our regulators and making sure that what we're doing meets all of the cybersecurity requirements. And I think the secretary mentioned NIST, and so we're kind of closely following NIST, making sure that we are complying with those requirements, and we're also being supervised and to ensure that everyone is comfortable with what we're doing. So I completely agree that we really are. We're operating currently within a framework that is designed to ensure that this changes in technology and innovation are adopted and used in a way that is safe for the providing financial stability.
Well, that's great. Thank you all. I hope the conversation was helpful for the audience, and glad to be able to do it with you. Thanks.
Thank you.
Thank you.